Today, we'll be determining whether someone who is 61 with $2.1 million in their RSP can retire or not. We are certified financial planners, and every year our company helps individuals maximize their retirement plans and make the right choice when it comes to decisions like this. Even those with substantial RSP savings often face unique challenges that aren't addressed by the standard retirement advice you find online. That's exactly why we're making this video today, to explain why having $2.1 million in your RSP doesn't automatically mean you're ready to retire, especially in today's Canadian economy.
So I think before we dive in, it'd be important to go through a couple of assumptions about this scenario. And like the title says, the person's age is going to be 61. They're earning income of $180,000 per year. They do have that RRSP balance of $2.1 million. And we got to look into what their lifestyle is going to cost. So currently, lifestyle is about $120,000 a year, call it about $10,000 a month. And it's going to have some limited flexibility due to unforeseen expenses that may be coming up, whether in the form of home repairs, travel, family support, things like that. Obviously, being at 61, they're 4 years away from CPP and OAS eligibility, or at least full CPP and being able to draw on old age security, meaning they're going to rely solely on their RSPs and that income for the short term. Now, this person does have a spouse at the age of 59, earning about $90,000 a year with an RSP of about $900,000 as well. Their main goals is they're going to want to enjoy the first 5 to 10 years of retirement through travel and hobbies, which would require higher, earlier spending than normal.
The go-go years.
Exactly, the go-go years. They want to leave a financial legacy behind for their family or maybe some charitable causes, and that may reduce some of the funds available for some retirement income.
So those are some of the assumptions about the spending and what they should be considering. But what do they have in terms of their net worth? In this scenario, they have a home that is mortgage-free, about $1.2 million in value. They also have other liquid assets, the TFSAs, each having $100,000. Now, this is relatively modest compared to their RSPs, but knowing full well that that is a tax-free income source that they can tap into. Luckily, they don't have any significant consumer debt, but what they don't have are those defined benefit pension plans from an employer. So when trying to determine whether or not this household can retire at age 61, we have to ask some key questions. Now, the first question we should consider is, how long do they expect their retirement funds to last, given their longevity risk? So in this scenario, they have a family history of longevity, living 95 and beyond, meaning that the retirement funds may need to last between 30 and 40 years. And that's a fairly long time. That puts a lot of pressure on the assets to last. So why does longevity risk matter? Well, the risk of outliving your retirement savings is very real. Even with $2.1 million in RSPs, you may need to account for 30 plus years of withdrawals, and a longer retirement requires a sustainable strategy to avoid fund depletion.
Yeah, and that's going to lead us into our second question. It's how will investment growth and market risk affect their portfolio? Now, we know their RSP is heavily invested and they face potential market volatility, which could impact their portfolio's value. This becomes a bit of an issue because heavy reliance on market returns in retirement can be risky. A significant market downturn in early retirement could lead to, a pretty big permanent reduction in savings, impacting their ability to fund their lifestyle. So a very aggressive portfolio could lead to too much volatility, and that could impact things.
Definitely. Now, the third key question that we should consider is, how will the sequence of returns impact the withdrawal strategy? Now, you mentioned earlier with the amount of volatility with a very heavily stock portfolio. So if you start withdrawing during a market downturn, well, you'll need to draw down on a lower portfolio balance, which can lead to quicker depletion. Now, the timing of returns is crucial in retirement. Early losses mean they're drawing down on a reduced balance, which could lead to faster depletion even if markets recover.
Yeah. And that leads to the fourth question, and it's a big one because especially more recently, how much will inflation impact lifestyle costs? So we saw it in 2022, inflation reared its head, and now with this situation, they expect to maintain about $120,000 a year in lifestyle costs. But inflation will likely increase these expenses over time. It's $120,000 today. So what we know about inflation is it's going to erode the purchasing power, meaning today's lifestyle costs may be significantly higher in 10 or 20 years. Right. Accounting for inflation is key in ensuring their funds can sustain their lifestyle over the long term.
Yeah, got to make sure that your funds outperform inflation. Want to be able to purchase the same amount of goods and services that you do now.
Yeah.
So next question, what tax implications will they face when you're taken from your RSPs? Now, we all know RSP withdrawals are fully taxable, which could put you in a higher marginal tax bracket during retirement. And taxes, we know, significantly impact retirement income. High withdrawals from RSPs can lead to large tax bills, reducing the net income available. Tax-efficient withdrawal strategies are critical for maximizing your after-tax income.
That brings us to our next major question: is healthcare and long-term care costs accounted for in this scenario? It's a big thing that we've been seeing, and it's very expensive. They're in good health now, but long-term care costs could arise in the future, and that could throw a wrench into plans. Yeah. Future healthcare costs, especially in long-term care or long-term retirement, can strain finances. Planning these potential expenses could help avoid surprises and support long-term financial stability.
Absolutely. Absolutely. Last question to consider. How do they plan to generate predictable income without employer pensions? And we talked about that. There's no predictable defined benefit plan. Well, if they have no employer pensions, they'll rely on RSP withdrawals and government benefits. Without a guaranteed income source, creating a predictable income from investments is essential. So you may need to structure your RSP withdrawals or consider annuities to secure that steady income stream.
So there you have it. You have 7 major questions that you need to consider in this scenario to see if that retirement would even be possible. And it's a perfect example as to everyone's situation is going to be a little bit different, right? You hear $2.1 million in RSPs and instantly you think, absolutely, they could retire. Why not? Everyone's situation is going to be a little bit different. There's going to be different factors that you need to consider that probably aren't even on your radar in terms of things you should be worrying about. That's why, what we always try to look at is looking at the financial plan based on everyone's individually tailored situation and figure out whether this would be possible or not. Whether that's in good markets, in bad markets, whether that bad markets happen 10 years from now or they happen tomorrow, we want to make sure that you'd be able to retire regardless of the situation.
Now that you know why someone who is 61 with $2.1 million in savings can't retire, you can better prepare for your retirement. But here's the thing. You need to understand one thing. These RSP withdrawal complications are just the beginning of what you need to consider. You can't walk away from this video thinking that a large RSP balance alone guarantees a comfortable Canadian retirement. The truth is, we meet with Canadians every single week who have substantial RSP savings but are shocked when they learn about the hidden costs of retirement that eat away at their nest egg. And since this is only a short YouTube video, we couldn't go into as much detail as we'd really like to when it comes to Canadian retirement as a whole. So that's why we're hosting an entirely free class this week to break everything down in much more detail. So if you're a Canadian who is serious about planning a successful retirement, click the link in the description to register. We'll see you in the next one.